Double entry accounting. Double entry accounting is an accounting system that records the two perspectives of every economic event. It provides more detail about two things. One, its source, or where the funds came from, and two, its use. How were the funds used? Every transaction is recorded through the use of a credit and an offsetting debit, such that total debits always equal total credits in value. So debits always represent uses of funds, and credits always represent the sources of funds. T accounts. Double entry accounting is depicted through the use of a T account, named for its resemblance of the letter T in analyzing transactions. And if you look at a T account, you normally have on the left side, it's like you have the debits on the left, you have the credits on the right. The debits increase in assets are depicted as debits, and decreases in liabilities and shareholders' equity are depicted as debits. And then on the credit side, you have increases in liabilities and shareholders' equity. These are depicted as credits, and also decreases in assets. They're depicted as credits as well. So once you understand this, the balance sheet identity, assets equals liabilities plus shareholders' equity, it can now be rewritten in the form of a T account. So notice that the debit and credit signs are reversed on the two sides of the balance sheet. Why is this so? Well, recall that debits always represent uses of funds. Credits always represent sources of funds. Uses of funds must always equal the sources of funds. So, why is double entry accounting important? Well, it facilitates understanding of the relationship between assets or your resources and liabilities and shareholders' equity, your funding. The income statement, the balance sheet, and the statement of cash flows are connected. The relationship among these three statements and their impact on one another can often be initially illustrated through debits and credits.